Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, capital markets, and the digital landscape. My name is Jill Malandrino, and joining on the desk this afternoon, we have Phil Mackintosh, Chief Economist at Nasdaq, Chris Dearborn, Managing Director on Nasdaq's Market Intelligence Desk, as well as Steven Wieting, Chief Economist at Citi Wealth. And we are here to discuss investor sentiment as we're coming into the election and why policy really matters for businesses going forward. Stephen, it's great to have you with us. Welcome to Trade Talks. Welcome to the market site. And it's almost like take your pick here, right? What data point is the market focusing on today? And it really seems as if until we get through the election and we get a better reading on policy, it's going to be kind of pick your data point.
Yeah, look, again, who is in office hasn't determined whether the economy has grown or not, whether there's been positive returns for the year. But at the margin, it's going to be really important. We think, the U.S. is going to have a lot of influence on the rest of the world. There's going to be a sigh of relief where there's going to be concern, depends on those particular policies. But the other thing that's going on that's really interesting right now is, we haven't had an up October during an election year since 2004. And yet we all know this data now. We use quantitative methods. We do data mining to pre-position because we generally have a great relief from all of this anxiety and anticipation afterwards. So are we even going to get all of this concern play out in markets when everyone is playing that game? So I think that's another, interesting point going into this period.
Yeah, and Phil, I mean, for all intents and purposes, the data's been quite good, or not as bad as expected for sure.
Well, we got the positive employment data a week or so ago, which kind of gave everybody a little bit of a fresh, I guess, positive outlook. But in reality, the employment data has been softening. The number of new jobs is a lot lower than it had been post-COVID. The wage pressures because of that are slowing. So there's a lot in the economy that's much more normal now than it was a year ago, 2 years ago. I think looking at the election, you're 100% right. The data shows that typically it doesn't matter who's in power. The economy is much more important. So what I'm seeing is, you get a positive employment data and the market gets strong and rates go up. You get weak employment data and the market gets weak and the rates go down. So really, I think we're not looking that much at the election right now at all. We're looking much more at the data, but we're at one of those pivot points where the Fed's cutting. Will they cut 100 this year, 125? Will next year it continue, or will we end up higher for longer again?
And of course, that employment print sort of threw that calculus
out
of whack.
And that's the problem. But then you look at some of the economists that are on the street saying, there wasn't a high submission rate, so it's subject to revision. The seasonals helped it a lot. So a lot of people now are saying maybe it was way more positive than it really was. And so we might see, when we get revisions, it wasn't as 250,000 like we think.
Yeah, and Chris, part of it too is the consumer continues to be resilient for the most part.
To Stephen's point before, and we'll get to the consumer in a second, is that the traders seem to be hyper-focused on whatever the data point is that moment, in the moment each day to move the markets. And that trend continues to happen. Right now, we're in the buy the dip mode again, right? And for the last 3 months, the markets have sold off for the most part in the first week and then rallied throughout the course of the year. Granted, we have earnings coming up, so there could be another couple of one-offs. You had Pepsi yesterday, you had a Helen Troite, you've got banks coming up soon. There's going to be a couple of things that people can actually sink their teeth in, but it's the data du jour that's really driving the markets on a day-to-day basis. To the point of the candidates, they really haven't given enough for the market to sink their teeth in. If one wins, you have your basket of where you're going to go. If the other wins, you're going to have your other basket of where you're going to go, which is no different. But until something happens there and some headline really kind of jerks the market a little bit, it's going to be status quo for a little bit. We're up a little bit today. The Fed minutes didn't really give us anything from the headlines that I read. A little bit of debate back and forth, where the quarter or half, but Powell.
I don't think there's any expectation in November anyway.
No,
certainly not the day after.
Absolutely not. Things seem to be lining up very nicely for the current administration with lower gas, especially with the conflicts that we have going on. Decent enough job growth, not great but good. Wages are okay, and the non-farm payroll print was good. From there, if you look at the consumers, you did see a downtick in spend in August. But the expectations are they're going to continue to spend. The credit card data was a little lighter than expectations were, at about under 9 billion. Issuers are still warning, though. When you look at what they're saying, everything comes down, especially on the retail side, to this quarter coming up, and that's the bigger concern. If you look at the lower income bucket and the folks there who've been doing without for the most time, where are they going to go to spend for Christmas? They're not going to have their kids without, so lower rates, on the credit cards, even though it may take a little while to come to fruition, whether it's 2 quarter points or even just 1 quarter point for the rest of the year. It's trending in the right direction. They'll spend, but the dollar stores just aren't picking up where that is. There's the have and the have-nots. The off-price are doing well, and some of the superstores are doing very good because they offer a mix. So it's really still what they're forecasting. Pepsi's numbers were good enough. On the staple side of it, but still it's a wait and see. There's not enough data out now for the earnings to really see.
Well, they cut savings rates already, that's for sure. They weren't. They
that
didn't wait to do that.
Yeah, mortgage rates went up, so and you got you have 4% on the 10-year. So I don't know.
Yeah, it really is a mixed bag.
Don't.
But Stephen, it also feels as if geopolitical volatility has been relatively digested well.
Well, look, the hit ratio, the chance that a regional geopolitical shock is going to change the direction of the world economy, it's a very low probability. There's been 2, beginning with World War II. So again, these things can have terrible negative effects. If we're looking at it through the lens of petroleum and prices, let's recall that prior to the invasion of Ukraine, we were at $80. And after all this terrible news, here we are again, the same level. So it's really difficult to make that one a particularly potent driver. I think, as you heard, I think the reason why we're up more than 20% for a second consecutive year is, we went through a tremendous amount of upheaval in the economy. There was a period of severe rate hikes, declines in the stock and bond market together, the worst period, like only 3 years like that in the last century, back in 2022. We're now in a year in which corporate profits are accelerating and rates are getting cut. And the labor market is slowing down and is getting us some level of relief from the Federal Reserve. But when you take a look at estimates for the 3rd quarter, we just went from 12% EPS growth. Do you believe it now, 4? No, these estimates are low yet again. Companies are going to beat them. And in the last quarter, 9 out of 11 sectors posted EPS gains. So tech no longer has exclusive growth rights. Now, again, if you take a look, it's been inconsistent. If you're looking, we're here at Nasdaq, the tech tape was strong yesterday. It hasn't been wonderful since mid-June in terms of making new highs. But broadly speaking, the economy is poised for some fairly attractive non-inflationary growth in profits. It's been great behind us. I think it could still be reasonably good ahead of us.
Yeah. Phil, when we talk about inflation and of course what's happening with insurance in the South due to the hurricanes and so forth, and we know that's been a big factor in terms of the inflation calculus. I mean, could that really be an impact? I mean, I've read rates could go up anywhere 40 to 45%, and there's got to be somewhat of an impact in there.
Yeah, I mean, in the inflation numbers, the insurance data is coming through for cars. So it's kind of like a 3rd order effect where the car prices went up because of the chip shortages, and then crashing your car costs more to fix, and the insurance companies are kind of catching up to that increase in cost. That's actually starting to come out of the inflation story though now. If you look at the components of inflation, energy's deflationary, goods is deflationary, and food, I know everyone doesn't think it, but is almost not inflating at all.
Year over year.
Year over year.
Right.
So really the inflation story is services, which is wages, and housing, which I think is a bit stuck because it's rent, which there's a lot of demand for rent because no one's selling their house. The one interesting thing was looking at some of the mortgage refinance data. It looks like already with the rate cuts, people are starting to get to the refinancing. So that could start to free the housing market up, which would be good for anyone trying to buy a house. And in a way, it'll be good to see rates coming down more for people that want to buy houses and get out of renting, but also for the small companies. So I mean, you're talking about the broadening of the income gains in the large cap space. It's interesting because the small cap is still in kind of an earnings recession, but I was talking to some of the issuers last week, the wage gains have really hurt a lot of them, and the ones that it hasn't had that effect, the interest is higher. So the interest expense on the small cap complex is higher as well. So they've had their margins squeezed by the monetary policy and the COVID wage hikes.
Can I just say, I mean, if anybody who thinks that the Federal Reserve didn't have any traction along the way, housing turnover is about 30% below 2019 levels, pre-COVID levels, right? And as you just said, small companies that have access to the corporate bond market are paying 9%, right? So that's coming down. That pressure is coming out. And so, there's been significant hits to the economy along the way while we've still been making progress. So I think as some elements of the recovery slow, particularly again, social close services, travel, leisure, et cetera, even retail, there's just a lot to bounce back.
Yeah, there's certainly. So it sounds as if corporates handled this inflationary environment quite well for the most part.
The price we paid for is we'll all tell our children about how inflation went up. You know, I'm sure nobody will have the right number, but it was 7% on average for 2 consecutive years. And we don't deflate the economy down to get us back to our old purchasing power. Last time that happened was the 1930s. It didn't work so well.
Yeah, I mean, even when we think about the housing market, it's really more of a supply issue than rates at this point. And I don't think there's an expectation that we're going to get back down to, you know, 2.5, 3.
But it can improve from where we were.
It certainly can, but I think, you know, Chris, to think it'll get back to those levels, in a way you almost hope not. You don't want that many rate cuts, because that signals there's really something wrong.
You know, you look at the Fed fund futures, they're pricing in 2 more quarter points for this year. They've been, the futures have been wrong for the last year and a half. You know, going back to last year to now 6 rate cuts for this year, you know, or more was what they were projecting almost 11 months ago. You know, but trust the set plot. You know, we'll get to the 3%, 3.5, really maybe 4 is kind of where we will. You guys are more in tune to that. I'm just looking at the markets. But when you look at that, you know, to Phil's point and to Steven's point, housing's always the tail, and that's where it's going to come from. Rents will always take a while to come down. I don't think that you're going to see the mortgage market move as much until there's more definitive moves within the Fed cuts. So until they start to move it more, look at what the 30 years did. They went, you know, dipped and then they rose back up last week. You know, the 10 years back above 4%. Even though the curve is kind of flattened a bit, it's not healthy yet. That, you know, that's going to take some time. Stocks are doing okay. Mortgages are doing okay. So it's 6.35 right now or something like that?
I think the number of banks that are going to lend at that, as their cost of funding comes down, you're going to find more competition. There's just going to be more willingness to lend. And you can see this. This is another sign that we embedded a recession. We had more than 2 years of tightening lending standards by banks with the yield curve inverted, and it had effects. But at the very time that we were absorbing all of those effects, we had, again, hiring in the services sector, you know, derailed by COVID, come back and mask it all.
Yeah.
So I think, again, it's not going to be boom. There's nothing V-shaped in the overall economy, but you have pieces of improvement that can still come in.
The markets keep moving in baby steps higher. You sell off, and it's vicious when you sell off. And lately, it's been a 1 day as opposed to 4, 5, 6, 7 sessions or longer. If that keeps happening, like I said when we started the session, that buy the dip mentality is still in play, and people are still going to be doing it. You know, there's nothing wrong with that. If you're looking for a quick entry point or a better entry point than where the stock is on a normal day where it's just baby steps higher, you know, when we were trading on the floor, it was always that same mentality. You buy the dip, you buy the vicious move, and you just wait for it to come, and it is coming.
Can you talk about implied volatility when you get the sell-offs and what you can do with that, again, as an investor? You can use that, again, for your entry points and income and, you know, augmenting your returns and protecting them.
100% entry point. Entry is the key to better returns. You know, and it's an old, you know, trader adage, you know, the higher the volume, you know, the better
you want the volume and the volatility.
You want the volume and you want the volatility.
Right.
You don't sell off on low volume. It's high volume, gives everyone an opportunity because the programs and everyone else is chasing. But when your markets are moving higher, it's generally lower volumes and it's baby steps, and that's where you got to wait and take advantage of it before it happens. Yeah.
Well, I mean, there's something there for everyone. If you have the, you know, the intraday volatility that we've seen, whether you're a day trader or swing trader, but at Citi Wealth, when you're advising longer-term clients, you're thinking of stay the course.
Yes. Well, you know, of course, and there are relative opportunities. You know, look, in 2020, we were, you know, underweight fixed income and cash at 14%, which is for us is, you know, enormous. Now we're 4.5% underweight fixed income and cash. And I take a look at American bonds and the loan market, the preferred market. There's all sorts of interesting segments. It's really, again, non-US yields for investment grade are 2 3/4. And, you know, we're complaining about 4.
Right.
So we have opportunities, and right now we've been very tactically overweight U.S. assets and fixed income and equities, particular segments that have been left behind, broadening trades. It's not that you don't like, you know, Mag 7 for the long run, but there's been, you know, a lot of good fortune there. So it's that, and I think we really, again, post-election have to see how much Fed easing we're going to have, what specific policies will we have. A red sweep with tax cuts and tariffs is different from the status quo.
Yeah, it certainly is. All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me for Market Site. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.